Hi and welcome to Reliance Expert Series. We have with us today Mr. Sanjay Parekh, Senior Fund Manager, Equity Investments. It's always been a great opportunity to understand the equity market scenario from an investor's perspective. Welcome, Sanjay. So, Sanjay, how do you see the markets going ahead in the light of various domestic and global factors?
Right, so we had a great 2007 for equity returns, and one will have to look ahead with a 3-year time frame. And we believe that over the next 3 years, earnings growth could be in mid-teens for the next 3 years. And even if you take some de-rating ahead, it will still mean good appreciation for equity as an asset class.
Okay.
So we are positive and constructive on equity for the next 3 years. And on the global front, the world is looking better. US is recovering. The capex is at the growth in capex in US is around 6%. The unemployment is at an all-time low there. We have now almost 110 months of synchronized recovery in US, and there is no euphoria as such, barring few pockets there. So we've seen a healthy reaction there as well. And we think that US recovery would definitely be looking up, and that is good for the world markets. Europe also is looking better, and we don't see any major hiccups in the world, which is quite well for the Indian markets. On the Indian domestic macro, we have some headwinds, but by and large the macros are strong. So we have crude within the range which is controlled. Interest rates are, by and large, they shot up, but then you've seen them receding. Fiscal deficit, there were some concerns on GST, but I think there is a clear expectation of recovery in GST, and hence there is a discipline from the Finance Ministry on managing the fiscal discipline. As I said, we've got an initial outlook of good monsoons. So macro per se, inflation is in control. So macro per se, I think we are well in control. There were some headwinds, but by and large, and the economy is recovering. That's the best thing. So we're quite positive on the domestic recovery. There are some headwinds like private capex is not happening. The resolutions have to be faster and deeper. And we're not saying we're not having headwinds, but we can sail through them. So overall, we are constructive on the domestic macro, and globally, world looks better.
Okay.
That's our mindset.
So given the current market scenario, how do you think one should invest, through lump sum or through the SIP mode?
So we believe it's all about asset allocation. So if somebody is under-invested into equity, after this reaction from the peak of 11,000 is a very good time to surely do SIPs and step up on SIPs. But for lump sum, if somebody is under-invested, one should gradually increase their allocation into equity the next few months. So that's what we think, because equity we're seeing by and large as an asset class. We've seen underinvestment in equities, and the Indian savings are more channelized to other asset class, and we still have a very small portion, 3 to 4% of savings into equities, where there is enough scope for reallocation up.
So given the current valuation, how much of large cap allocation do you intend to keep in the Reliance regular savings fund balanced option and the Reliance equity savings fund?
Right, so one is on the valuation. So even if we take the downgrades due to the corporate banks going through the pain, we still feel that we'll end this year on March 18 at 460. But that March 18 is behind us now. As we look at FY19, and even after factoring the downgrades on corporate banks, we should be broadly in the range of 560 to 570 for 19, and then more like 670 to 680 for FY20. So broadly, we are at 18.5 times on 19 and 15.5 times on 20. So I think the price correction that we saw from the peak has happened. We could see some more, a little bit of that, but there could be some more of time correction. And then, one looks at, in the next few months, we'll look at not only 19, but FY20 as well. And 15.5 times for FY20 is a very reasonable valuation. So we think that is a possibility, and that's quite healthy, that you could see some few months of time correction. But price correction, I think by and large we are done. We could see some more of it, but this correction has been quite healthy, which should be used as an opportunity to gradually step up equities. On our funds, on Reliance regular saving balance, which is maximum where we can go 75% equity. In our ESF fund, maximum we can go is 40% equity. The Reliance Retirement Wealth Option, it's run like 100% equity fund. So in all these funds, the portfolio construction is by and large similar. I mean, the holdings, the overweights are by and large similar. It's not exactly identical, but it's a similar portfolio. And all of these funds, around 75% of our equity is in large cap. And mid caps we would only buy if the large cap, mid cap divergence in valuation is higher. And that discipline we maintain across our, in all the funds, which has worked very well for our firms.
So what are the themes or the sectors that you're positive on?
So we're positive on the domestic consumption, and that we're representing through private banks, which is a big overweight for us. We are overweight on auto ancillaries. We've also got representation in FMCG, media, retail, and telecom. So all this put together more is like 53-54% of our portfolio. And when I say private financials, there's private banks and also a bit of private insurance. Okay. So all put together, that is what we think represents consumption. And 53-54% across these funds is in consumption. The second basket we are positive is on investment, the theme investment, which is represented through overweight on materials, cement, metals, quality capital goods, and select oil and gas. So we believe if one has to play the India investment recovery theme, these are the sectors to bet on. By and large, we've looked at the leverage within the stocks that we've bought in. Right. So when the cycle turns, we don't want both operational risk has to certainly get lower, right, but financial risk also has to be much lower. And there are very good opportunities across, in the metal space also. Clearly, there are tailwinds, right, because the protection from to the Indian metal space is higher. We have a MIP there. The chances of China dumping into India is far lower. Right. They are closing the capacities, which augurs quite well for our ferrous metals. So we've taken conscious overweight calls, say in metals at 8-8.5%, materials, which is cement, more like 8-8.5%, oil and gas utilities is more like 7.5-8%, and capital goods stroke roads is 7-7.5%. So it's quite a well-balanced theme that we had across all the 4 sub-themes, which is more like 28-30% of our portfolio. The last is outsourcing, where we are a little less positive, which is technology and pharmaceuticals, healthcare, where we are underweight, and in pharma we are a little lower than what the weights are. And we believe there is some more time. There are certain concerns on growth, and we want valuations to be a little more comfortable before we step up our exposure to those themes. So this is broadly the portfolio construction of all the 3 funds.
So in the Reliance Regular Savings Fund balanced option, you have overweight on the infra theme, like construction, building material. How do you see it's going to benefit to our investors?
Right. So we think that if the India recovery has to happen, we are very confident. We've just not even scratched our surface in terms of the infra investments that can step up. Then you certainly have to invest by biting that theme through. One is cement, because you certainly will need cement as a base raw material. You need steel. I mean, our capacity utilization is at a very high level for us. All the existing players will benefit. Some of the M&A that we are seeing of they acquiring this players in the resolution mechanism will actually be mildly positive at times if the acquisitions is right. And as I said, they are protected. So we are seeing those certainly in the results ahead. And we believe that the profits in terms of the profitability is sustainable and the cash flows are getting better. So the situation on debt is far better today for the existing large steel players. That is what augurs well for them. And then you can selectively, we looked at selectively at oil and gas, where again you could participate, because that's a steady stream of utility sort of businesses with some vulnerability. But by and large, we believe they're very reasonable on valuation. So we've participated, and then selectively small way road play. Because we think that is also a very good opportunity to be there. Quality capital goods, high quality capital goods, select roads, select oil and gas, materials, metals is the whole scheme of things that we have invested into within the sub-segments of the investment recovery.
So in the last few months, the PSU banking space has been witnessing headwinds. So how is our banking fund placed?
So in our banking fund, we were underweight into corporate banks, and within that PSU banks also we had quite a underweight. So we significant underweight in corporate banks, significant underweight in PSU banks. Okay. So that helped us significantly, and we were positive on the private banking space where the asset quality problem is the least. Okay. And almost 42% of our portfolio was in those larger private banks where the asset quality problem was much lower or almost insignificant. And that helped our portfolio. And then we have selectively into NBFCs, stroke rating agencies, stroke insurance, which is done quite well in this fall where corporate banks have got affected more. So our fund has that way benefited during this period.
Thank you so much, Sanjay. It was a pleasure having you with us today. It was indeed a very insightful discussion to have with you, which would definitely help our investors invest better. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.